Well, we have seen continued movement in the bond market, y'all, and not all of it in a great direction. We have been talking about interest rates increasing. We're going to dive a little more deeply into why that is happening and try and get a read on where we might be headed post-election. We're going to talk more about politics today than we normally do in the past, so buckle up while we dive into it. Today is Thursday, the 14th of November. I hope you are doing well. We did get some news this week that we need to look at. Consumer Price Index came in exactly as predicted. It was up from 2.4% to 2.6%. Again, the importance there is it met expectations. We had a fairly low year-over-year number to compare this to, so we were expected to be right where we were. Producer Price Index was actually a little hotter than expected today. 2.4%, that was hotter than the 2.3% expected. We didn't really see any negative movement in the bond market as a result of that. I think the consensus was between those two reports that hitting fairly close to the target was enough to put a little bit of a relief rally in the bond market, which we are seeing today. We're also seeing a little bit of weakness in the stock market. Dow closed down a couple of hundred points today, so that allowed some funds to flow back into fixed incomes, and we're seeing that reflected in today's pricing. Diving right into the numbers, Mortgage News Daily has a 30-year fixed rate conforming loan at 7.02%. 6.98 is where that survey was a week ago, and 30 days ago that survey was at 6.62. Just as a reminder, y'all, 2 months ago on 9/11 we were at 6.11. That was the low mark for the year. In fact, you have to go back 2 years to find rates back at that 6 1/8 level, back all the way to January of 2023, where we were September 11th of this year. So we're up about a point, y'all, in 60 days. And here's why. We had touched on this in some of the prior videos that we've done, even leading up to the election, that when the polling changed, when specifically the betting markets were really firmly in Camp Trump, as far as the election was concerned, you saw the bond market start trading based on Trump policies that they view as potentially worrisome to interest rates. Let's talk very specifically about what those are. Number one, that spending will not be constrained since you have one-party rule of the House, the Senate, and the White House. It's a valid concern. We haven't seen much discipline from either party over the last 2 decades or more. Number two, that taxes will be cut, so that may mean larger deficits. If you decrease revenue into the government and you spend more money, then you have greater shortfalls that have to be made up with floating bonds to borrow essentially the difference. Y'all, again, I am not making commentary on whether that will be the case. In fact, when you look at 3 of the 4 years that Trump was in office, and every year since, we have seen revenues increase above where the Obama years were. So as far as revenue to the government is concerned, and we are still under Trump tax policies today. So in any event, a lot of debate over whether lowering taxes decreases revenue. The numbers say that it does not. The bond market thinks it will, and that's why you're seeing, again, some of the trades being the way they are. And that tariffs are going to raise the cost of goods, increasing inflation, and then we're going to get back into this cycle of the Fed having to tighten again and money supply getting more expensive. Those are the 3 big areas where the bond market is trading today. So what may happen in the future that would cause that to shift direction? Well, number one, they might actually spend less money. We've got something new with this administration, and y'all, and if you look at the picks that we have seen so far, the one thing that no one can deny, regardless of whether you're a Trump supporter or not, he is at war with the swamp, with the picks that he has made so far. The 16 people that he has selected so far to be a part of his administration are total outsiders with regard to the majority of those picks, and they may well bring a fresh look at spending to this administration. That remains to be seen, y'all, who's going to win that battle. There's a lot of entrenched interests that are going to make moving the needle on spending very difficult. But if anyone is focused on doing it, we may see a level of that here that we've not seen in past administrations, including the first Trump administration. The second being that tax cuts are going to produce growth that outstrips the negative nature of that revenue coming in as far as fiscal policy is concerned. Well, y'all, that is certainly the case if you lower the corporate tax rate and you have companies that are receiving all of their profits overseas. They bring all of those profits home to enjoy a lower tax rate here corporately. then they have repatriated a lot of taxable income that then increases revenue. That's just one area where tax cuts may well bring more revenue in if it increases economic activity at home. And of course, the last being tariffs themselves. These tariffs, if they are implemented, are designed to be waived for companies that then produce those products in the United States. It's going to result in a lot of companies that find it more attractive, y'all, to keep jobs here at home, keep that revenue here at home, and pay taxes on that income here at home. So this is what's out there, y'all. Are those things going to actually yield the result of more fiscal responsibility and lower deficits going forward? We're just going to have to wait and see how entrenched the swamp is on keeping the status quo versus actual quantifiable change. Your guess is as good as mine as to who's going to win that battle, y'all. I'm actually excited to see it fought, though, and we will have more to talk about next week as things continue to coalesce. Anyway, stay blessed, stay safe. We will talk to you next week.